What is this? Is this a all-in stock? This EOS Energy? That's what Twitter was telling me, so it means it's probably shouldn't do it. But I wanted to check it out with you guys to see. I'll do three things. I like to look at the latest earnings, the current valuation, and kind of other things about the stock. So we'll kind of go on this journey of discovery. It says this has battery storage solutions for the electricity industry. It's in Edison, New Jersey. I was looking at their latest earnings here, and the first thing that's interesting to me is that their revenue exploded year over year, like 5x. That's massive. You don't see that. You don't see that very often. The unfortunate thing is that the cost of goods sold also exploded to the point where it took all of the revenue and then about another 100% of the revenue, and your gross profit increased money-wise. Something to note, though, is that percentage-wise, it actually got better. Because last year, I guess what I'm saying is the gross margin percentage actually improved year over year. So that's something to note, but that's very high cost of goods sold. Are the COGS of EOS expected to stay high? What has management said? Let's just see. Cause we gotta start looking at that. Okay, based on the report measure, COGS expected to decrease significantly on a unit basis over the remainder of the year. The total COGS will scale up as they meet their aggressive revenue guidance. 300 to 400 million. Dang. Holy cow, guys. See that? They're saying that if this goes up to 400 million, that's another like 4 or 5x. Holy cow. And then what I would bet this COGS is they must have a bunch of fixed assets that are being spread up per unit. So not necessarily the end of the world, but yeah, holy cow. EOS. Dang. I had kind of a pullback to this 5, and now it's kind of coming back. Alright. Research and development up. G&A pretty much the same, slightly up. And then the operating income is up. Again, mainly just because of this COGS cost. They do have a hefty interest expense here, which must mean they have a lot of debt. And then not seeing. So look at this, guys. This change in fair value of warrants and derivatives has turned it around. So it looks as though they have a net income. Which they definitely don't if you exclude this. What is with the change in fair value of derivatives and warrants for EOS? So that's gonna, yeah, okay. Completely distorted their GAAP bottom line. Net income of 5.8 million, despite earning operational loss for 4 million. Yeah, what's going on here? Okay. Yeah, so that's just a non-cash financial gain. When they issue convertible notes or senior debt or warrants like these, they have to classify them as liabilities. So just this is a paper adjustment. So something to look for, because I already know on your apps it's going to show like a massive net income, but that's all related to these warrants. They have a credit agreement with Cerberus. Yeah, ignore it when assessing core operational performance, which that is exactly what we're going to do. But just something to note there, because I guarantee if you were to look that up, it would kind of distort how the stock is doing. They got a lot of cash. I'm going to look at the cash. It looks like the cash flow was negative 44 million. We'll double check that. For a quarter, negative 44 million for a quarter, which is why then you're going to see these operating investing activities. They're burning 152 million a year. So they got 2.5 years of cash runway. They probably got to spend some of this cash on CapEx stuff and whatnot too, or maybe not. How much cash runway does EOS stock have, and how much of their cash is needed for CapEx and investing activities? Because it looks like not a lot, because they only spent 35 million on investing activities, so maybe they don't need to. Yep, we saw that, negative 120 million. Applied cash runway, so about 12 months. They expect it to deaccelerate, targeting a positive gross margin and positive by end of 2026. All right, that's something to watch for then. Because if that's true, that's when these stocks usually explode, is when they actually become profitable. I guess gross margin is not the same as net gross profit, but okay, so they use 35 million, which we saw that here. Let's see. Oh, look at this, guys. Anchoring a venture of 100 million equity commitment. Okay. So, all right, this is saying that what they have is tight. You're probably looking at some dilution, but if their execution is successful, I don't know that it's too much to worry about. So, all right, that's kind of interesting. That's kind of the earnings. That's what I got for you there. I want to see kind of more in here. Look at this. Institutions have been regularly increasing. Look, in Q4 2024, institutional ownership went from 38% to 62% in 2026. That's massive institutional buying. It's a lot. They're definitely accumulating this. These people are giving it a price target of 11. Whatever. Okay. CEO has the most shares. Insider activity. I want to see who are the insiders buying and selling the stock. Does it have employee-based compensation? Let's see, financing activities. Maybe a little bit. Can maybe have a little bit of it. Yeah, see, this is what I was saying here. Look at this gross margin percentage. See how it's improved? If you look at it, this is what I was saying at the beginning of the video, it's improved quite a bit percentage-wise. Okay, CEO is buying. And then other executives are selling because of their equity compensation. But the CEO is buying. What a Chad. Two open market purchases buying for a total of $500,000. Yeah, so we know the CEO's has some conviction. So that's always nice to see. But they do have, yeah, a lot of employee-based compensation. How has the total share count increased for EOS stock over the past few years? Okay, so that's a lot of dilution. So you went from 53 million to 337 million at the end of 2025. That's where most of their cash came from. Yeah. So the market now that's not necessarily. Oh well, let's read this. Checking share count, it will continue its upward trajectory through the second half of the year due to two major developments: authorized share increase and 150 million rights offering. So that'll probably keep going. Doesn't mean that it's that doesn't mean that you can't get it, because if you had bought here in 2022, you're pretty happy with your investment, right? Or even here, and it's been diluting during this entire time and still managed to make this push upward. So that doesn't mean that it's bad. It's just something to watch out for. Downside pressure. So I want to see, where was I at? Here's this. I don't know that price to equity matters too much, or this price to sales. It's giving it a 30 out of 46 compared to its peers. But the main thing I want to look at is this market cap of 2.85 billion. And we're going to use price to sales on this. So I think that their total revenue is this 56 million. So you can kind of look at that and say if you think that it's overvalued. Though you got to remember, they're projecting 400 million revenue by the end of this year. So, maybe that looks cheap if they keep growing and they keep doing that. Because Wall Street is all about revenue growth. That is their thing. That is their well, for some of them, it's their number one thing that they care about. So, as long as that revenue growth keeps happening, this maybe doesn't matter too much. It's all about that revenue growth. So, and historically it's at the 40% percentile. So, yeah, in terms of valuation, I don't know that the only thing I would really care about here is that if that revenue growth is deaccelerating or not happening at the path that they would like to do. Because if that happens, then that'll hurt the stock. Let's just see. I think we already got most of the main things. Yeah, here's this net share issuance. Issued a lot in Q4 2025. And the stock still went up a ton that year. So, I don't know if there's anything here that I really want to point out. I think that this for here is kind of shows me what I wanted to see here. But now let's ask the fun stuff here. I always like to look at the paper real, but this market's very about, forward stuff. So what could EOS stock grow into in the next 5 years? What is its world-changing um, narrative? Give me that bowl juice. Okay. Founder pillar of the global clean energy transition. The non-lithium savior of the grid. Lithium-ion batteries are fundamentally poorly suited for the future of the electric grid. Lithium-ion excels in electric vehicles because it is a lightweight and energy dense. 100% domestic toxic-free energy. Earth abundant zinc. They require no lithium, cobalt, or nickel. Dang. That's big. They do not catch fire, require no HVAC cooling systems, are 100% recyclably and manufactured in Pennsylvania. Ultimate made in America ESG security play. 100% recycle. Require no cooling systems? Dang. Artificial intelligence and massive data centers are pushing global power grids to opposite breaking points. These facilities require 24/7 continuous uptime. Wind and solar cannot provide this alone. The EOSE system is designed for long-duration energy storage, safely discharging continuous power for 4 to 12 hours to bridge the gap when the sun goes down or the wind stops blowing. Unlike lithium batteries that degrade over a few thousand cycles, EOS's Z3 battery cubes are built to last 20 years and up to 10,000 cycles with minimal degradation. If EOS successfully bridges the gap between a capital-hungry startup and a self-sustaining manufacturer, 2031 could look very different. 2028, they think a free cash flow of 75 million. So this is a long hold. If you buy this is a long hold. Or maybe not. Maybe Wall Street will price in what it will become and could moon quickly. Revenue could scale to 2 billion annually. Revenue expanding past 180 million. So yeah, this is energy play for all those data centers. That's why Wall Street loves it. So dang. In terms of the chart and the entry, this is kind of what it looks like. So I'm not really a chart guy. But if you guys like that stuff, it looks like right now it is above the 10-day moving average and the 5-day moving average, below the 20-day and 30-day moving averages. So yeah, there it is. All right. Well, this is kind of a fun one to look at. You guys will have to let me know what you think about it, or what, if you've been following this for a while. I think the reason why I heard about this one was because it was some post about the CEO like buying a bunch of shares, and they were kind of focusing on that. So let me know what you think. I'd love to hear, and I will see you guys in the